This is the discussion first of how to determine cost of equity for your project in Finance 311. We have a number of learning objectives related to determining cost of equity. The first one is related to specifically determining the cost of equity for your project. I'll have a separate explanation of how a corporation might go about doing it. And then we'll have a discussion about why it is that you can't use the same approach for your project. But right now, we're just focused on how you might determine that cost for your project. The process for that, basically, in order to determine it, all you really need to know is the amount of money that an investor is proposing to invest in your project. So not necessarily the total amount you need, but the amount that a particular investor is wanting to provide. What share of your business they want in return for that. Oftentimes an investor will ask for some percentage. I want a 20% stake, a 30% stake, a 50% stake in your business in return for my investment. And so you would need to know those. Both of those you would get simply through a conversation with a potential investor and a negotiation back and forth. The last thing that you would need to determine are the projected cash flows that the investor is entitled to get to, given the project pro forma projections you have and the share that you guys have agreed. Well, you currently have a project pro forma, but what you don't necessarily have is the amount that would be available for the investor. In other words, you have what the total amount is, but that doesn't reflect what's available for an equity investor. And so what we would normally do to solve for this is we would first calculate something called free cash flows to equity. And then we would need to determine a discount rate that would equate the present value of the cash flows to the amount being offered in return for them. Now, remember from our earlier discussions, a discount rate to you as the project is your expected cost of equity. To the investor, it's their expected return on equity based on the cash flows that they assume that they're going to get versus the amount of money that they're having to put up. And so the basic steps for this would be that you will calculate this free cash flow to equity, which I will show you how to do in just a minute. You will multiply the cash flow from equity or to equity by the share that the investor wants, so that you're reducing it down to the portion of that they would be entitled to. You would then enter in the amount that the investor tends to invest in return for this. So you have an amount that they are willing to give you today. You have the cash flows that they want in return for that. And now all you need to do is to basically solve for what discount rate would discount those cash flows back to the same present value as the amount they're willing to give you. And that is basically the required return they're asking for. And so to do that, you would normally just start by creating an assumed discount rate. You might put in, say, 10% or something like that as just sort of a reasonable start. Build your formulas that will discount each cash flow in each year back to present value. That's what we would call the discounted cash flows. And then you would sum all of those cash flows up, and that becomes the present value of those cash flows. Now, when you first do that with your assumed discount rate, those may not equal the amount that the investor is willing to offer. But if you were to either hunt and peck by changing the discount rate or use goal seek to solve for a discount rate that would make your present value equal to what the investor is willing to offer, you will arrive at a rate that makes the present value of those cash flows equal to the amount the investor is willing to offer. And that is the implied return that the investor would get for their investment. And so what I want to do now is switch over to your spreadsheet, and we're actually going to build out the free cash flows, and then we're going to go through this whole process. All right. So free cash flows in a nutshell, and I think, let me see. Yeah, I have not put a slide on that. I may build a slide on that for you. But free cash flows in a nutshell are made up of these components. First, you have an amount that is net income. And I'm putting that with a plus sign in front of it so that you know that you're adding net income. Second, you are subtracting from that net capital expenditures. Okay, and net capital expenditures, for some reason my minus sign didn't go through, there we go. Net capital expenditures are made up of the capital expenditures. In your case, that's probably going to be asset purchases. And then you're going to subtract from that your payments, your depreciation. So at the end of the day on that, I put a plus for that one, sorry. I'm a stickler for those. It makes everything work better. The next thing that you're going to do is you want your change in non-cash working capital. Why is it non-cash? It's non-cash because the cash also includes all the retained earnings and all that sort of stuff that comes from operating the business. And so putting that in and net income in would be double counting that. And so that change would be calculated, if you will, as current assets minus current liabilities minus cash now. And we'll just copy that down because makes it easier for me. Minus the same amounts, but for the prior period. Okay, and so we have put together what those components are. Now, the next thing that I have is I get to take any debt issued into this, because even though it's raised from the debt the creditors, to the extent that it's not used for anything else, it's available for payment to equity. And then I'm going to subtract from that debt repayments, which in our case is usually principal payments. If I can type. Okay. Oh, not valid because I put these backwards. Again, you don't have to go through all this fanciness, but for me, I like doing that. And so at the bottom, then we'd have free cash flows to equity as the result of that. And I'll just put that all the way over here to the right, bold it, just me doing my formatting. So net income in our case, we just go up and grab our net income number. Net capital expenditure, let's go down here. We'll get our capital expenditure, our asset purchase, which we already have entered here. We're going to do depreciation. So go grab our depreciation amounts. Depreciation amounts are up in our income statement. So we'll go grab that. And so with those, I could basically go ahead and get my equal that minus that. Okay, and so I care about the numbers that I'm going to bold. Those are the ones that I'm going to put in the final formula. The other ones are just to get me there. Current working capital is probably nothing, but let's see. It's equal to current assets find my current assets here. Give me just a second. There we go. Minus current liabilities minus cash. So not surprisingly for us, it's just our inventory. Here I'm just going to put a 0, and then what I'm going to do is going to copy this, because that'll be the prior period one. I'm going to put it down there. Okay, so that when I drag this over, there we go. And then the change is just going to be equal to this minus this. So in period 0, we build up this inventory that we're going to need. And then in period 1, we only need, looks to me like we actually needed less. I don't really know the whole story behind that, but that's kind of where we are right now. So then we need our debt issued equals debt issued, cash from debt, there we go. And equals debt repayments, those are our principal payments. So principal payments are going to be in the balance sheet, principal payments. Okay. So we're going to carry all those over, and we're going to bold those two because we care about them. And then using our information, so it's this minus this minus this plus this minus this. And that's free cash flows. So in the beginning, our free cash flows are not great, but then they start to get better. So we'll extend that out for the full. I'm going to extend it out. One of the things I did in this project was extend it out to 11 years instead of 10. And one of the reasons I did that, I know we only built this for 10 years, but we also built that the loan would be paid off over 10 years. And so as you can see, the free cash flows go up quite a bit at the end of the 10 years in year 11. And that's what I want to use for the terminal value. And so I'm going to go ahead and create a terminal value that's equal to this divided by 20%. And again, the 20% is just our guess at what sort of a typical discount factor on a business like this would be. So in reality then, what I have is the free cash flows are equal to these amounts throughout. Okay. Now, next step that I have to go to is I have to create a discount factor for those. So let's just say that our discount, I put it in the wrong place, sorry. Let's just create a discount rate. And again, I'm just going to set that to 10% right now. So we need the discounted cash flows. And those are equal to whatever that value is. Well, I'm going to make this easier for myself. That's at present. So we're going to put discount rate and years. So that's 0 equals that plus 1. So that's telling us how many periods out these cash flows are. And that just makes the math a little bit easier for me. So now the discount rate, or the discounted cash flow, is equal to the cash flow above divided by 1 plus the discount rate. And I'm going to have to put that little thing with a $sign on it, so that when I drag this formula over, things work, raised to the power of how many years into the future it is. All right. So if we do that, then what we get is something that says, here's what the present value of each of these cash flows is when we discount it back from whenever it was to now. Okay. So those are discounted cash flows. present value of discounted, we'll call it DCF. DCF is simply the sum of those equals the sum of all of these. Okay, so it's a big number. And again, part of the reason why it's such a big number is because of the big terminal value. That helps us a lot. See if there's anything else going in there. Just, it's always a good idea to check and make sure that your numbers make sense. In this case, let's see. It's not making so much sense there. I might have grabbed the wrong income. Yeah, for some reason I keep doing this. I'm not sure why I keep doing it. But, oops, sorry. Some reason I'm grabbing the wrong incomes. I'm not sure why, but we can go fix that. Equals it's row 12. There we go. So let's go correct that because these numbers look quite big. And dollar those. That probably looks more in line. And that brings our value down to something more realistic. Now, for our project, we had sort of assumed, if you will, you'll see that built in there, that the stockholders had put a certain amount of cash in, call it $70,000. Let's just say that $35,000 of it, that the investor contribution is $35,000. All right, and the investor share is they want 40% of the business, let's just say for that. All right, and so now we're going to go through and we're going to say, so what is the investor discounted cash flows? Those are equal to 40% this times 40%. Okay. And what is the return that equates this value to this value? That's what would basically be our result. So what I'm going to do is I'm simply going to go up and do a goal seek. So what if analysis, where'd that go? Goal seek. Set this value to 35,000 by changing this value. And so what that implies is that the investor wants a 31% return. Now that seems a little bit high to me, and so you might negotiate back on that and say, look, for that, you're only going to get 30% of the business. And so you would go back and do a goal seek based on that says, well, okay, let's see what it is at that. So set that equal to 3,500 by changing this 26%. And so you might agree at that. And at that point, you have solved for, I'm going to say this as forecasting example 5. You will have solved for basically what the equity cost of capital to you is and what the return to the investor is. So fairly straightforward. I realize there's a lot of steps. It's nothing that we haven't done before, but I wanted to show you that in a video. Obviously, if you have questions, I can cover those in class.